All right. My name's Craig Schwinn, and I'm the organizer of Securities Traders Group. Today we're going to be talking about Charting 101. And with that is really just the different components that go into charting. We're not really going to be talking a lot about strategies. We're not going to really be going in depth of really any component of a price chart. I'm just trying to get a general knowledge to a lot of the new traders that have joined the group and give them a starting point so that they can go forward and learn more about technical analysis and price charts. Just a little disclaimer, this webinar meetup is for educational purposes. Um, do not take this as specific trading investment advice, and that, of course, trading is a risky business, so just be careful with what you do. Today we're really going to be talking about technical analysis, the components of a price chart, support and resistance and how to find it, common indicators that many traders use on their price charts, and the different software that's available to you. So to begin before we start really with price charts, I want to talk about technical analysis real briefly. Technical analysis is really an art of forecasting future price movements based on analysis of price movement. I say it is an art as it takes time, experience, and practice to become a skilled trader using technical analysis. Now, technical analysis differs from fundamental analysis as traders are not concerned with the company's financial reports or economic conditions because they feel that prices already reflects this information. How many times have you seen a positive earnings report come out and the stock begins to drop, or the opposite happens? Instead of trading the news or reports, technical analysis will actually trade the price action. To make trading decisions, traders will use a variety of charts and indicators to analyze the price and its general direction. Traders are often develop rule-based trading styles, whether they are long-term traders or day traders. Having established these rules, it helps them make trading decisions that are based on predefined rules rather than making decisions based on emotional responses of price action. One of the things that these traders are trying to find and determine is the trend. The trend refers to a general direction of the stock's price. Traders use price charts and indicators to identify the trend strength and the trend's direction. There are three types of trends: up, down, and sideways. So the stock market's always moving, and it's always going to move in one of those three directions. Now, when you look at a price chart, there's three kind of phases that a price chart will go through, and that's the accumulation phase, the general participation, and a distribution phase. And price charts are used to identify these different trends. Now, if we go back, here's an example of an uptrend. An uptrend is defined as a series of higher highs marked by these arrows here, which then are also followed by higher lows. So this is a low, this is a low, and this is a low. Now a downward trend is just the opposite. It's a series of higher low or lower lows and lower highs. So you can see that the price will go down, it'll go up a little bit, go back down, go back up, go back down, and each time it's making a lower low. So this is just confirmation that it's in a downward trend. Here's an example of a sideways trend. Basically the highs and lows kind of fall within the same general region. So here's your highs here. Just draw a line. And then your lows are here. So it's never exactly perfect, but you can kind of see that the highs and lows fall in the same general vicinity. So, and then we also talked about the different phases of a stock. And you have the distribution phase, which is usually like at the top of a trend, and this is where market makers will start to get rid of their inventory or their stocks that they've accumulated. General participation And this is where the trend really starts to evolve, and retail traders and other market makers are getting involved, moving the stock either down or up, and then an accumulation phase. And here, this is where the market makers again are starting to build up their inventory or buying stocks and testing the different highs until it finally breaks out, and then you re-enter a general participation. So that's just a real high overview of technical analysis. Are there any questions at this time? All right. So like I said, technical analysis is trying to forecast future price movement on the past price movement. And they do this by looking at price charts. But what is a price chart? Basically, it shows the movement of a price of a financial instrument over a selected period of time. For simplicity, this applies to all financial instruments, but for simplicity, I'll be referring to stocks for the remainder of the webinar. Well, looks like I got a question from Carol. Go ahead. Can you type your question in, Carol? Oops. All right. Let's go back over here. Sorry about that, guys. Um, on any price chart, you have a couple components. You have time, which is shown on the x-axis, and price, which is shown on the y-axis. Price charts are the cornerstone of technical analysis and are used to recognize trends, charts, and candlestick patterns, and support and resistance. And I'll just kind of show you an example here. So this is a sample price chart of SPY. This was just taken recently. This is a line chart. It's a ETF SPY, which is 1/10 of the dollar value of the S&P 500 index. This is a daily chart, and as I said, that you'll see both time and price on this chart. At the bottom, you can see time, and over this chart actually shows 6 months, and then price will show the the price that it rose and fall within that time frame. So we could see that within the last 5 months, it went from a low of about 162 to a high of a little over 184. Now there's several different types of charts available. The type is determined on how the price is plotted. Some of the more common price charts are line charts, bar charts, candlestick charts, point and figure charts. And there are many others, but the ones I listed here are kind of the more popular ones. So looking at a line chart, it's one of the most basic charts. They only plot the closing price of a stock for a specific time frame. So if you're charting a daily chart, then the line will represent the stock's price at the end of the day. If you're plotting a price in 5-minute intervals, then the line would be the stock's closing price after 5 minutes. And then these plots are all connected by an individual line. So an example there is, again, the SPY ETF, and you can just see that that's the closing price over the last 5 months on a daily chart. Excuse me one second. The next chart is a bar chart. This is created by several vertical lines. Each time period is represented by that vertical line. And then it also shows additional information other than just the close. So as you can see there, we have the open of the price, the close of the price, the high of the stock price for the day, and the low of the stock price. So it's often referred to as an OHLC bar because it shows the open, high, low, and close. This was a very popular style of charting for a long time. The problem is that it's kind of difficult to tell right away, especially when you get on a chart. You have to look very closely to see, was it an open or a close? You know, did the price rise or fall? So like here where my mouse is now, the price rose, but then the next day it kind of dropped a little bit, and it's very difficult to see. Now, a lot of charting software these days allow you to color code the different bars. So if it was a down day, it could color them as red, and if it was an up day, they could color them green, or whatever color schema you want to use. So, but just for illustration purposes, I just wanted to show it, you know, in the typical black, and you can see that it's difficult to see, did the price go up or did the price go down. So to help with that, a lot of traders have gone to candlestick charts. It's very similar to the bar chart in that it shows both the open, high, low, and close values for a stock price over a period of time. It's just the way that it's drawn that it makes it a little more different. The high and low are still represented by a vertical line, as you can see here on both the diagrams here. However, the open and close price are used to create a rectangle, which is known as the real body. And then if the price was up, the real body is left empty. If the price went down, the real body is closed. So you can see here the image on the left shows an up day in price. The image on the right shows a down day in price. So then when you look at a chart, you can quickly see which days were up days and down days. Another chart that's not as popular but is used by some technical traders is known as a point and figure chart. It consists of columns of X's and O's, where X's represent rising prices and O's represent falling prices. With this chart, time is not a factor in creating the chart. However, numbers and letters are placed within the chart box in order to represent a month, the start of a month. These types of charts are used to filter out the noise of a stock movement's price and to help easily find support and resistance. Now, I'm not real familiar with it, but if you want to look into point and figures charts, I would suggest going to stockcharts.com for more information. They do a really good job at covering it. But just to show you an example of what it looks like, you can see that it's just a grid, almost like a graph paper, and each box represents a change in price. And then they mark the price change once it gets down to that price with either an X or an O, depending on if the price was rising or falling. And then you can see that there's numbers and letters within here. The months from January to September represent the numbers of 1 to 9, and then October, November, and December are represented by ABC. So if you kind of look at this general area here to the left, you can see that, you know, we hit October, November, December, January, February, March, April, all within that very short time period. So you can see that time, you know, on a regular chart that would go for several months across the bottom, but right here on a chart, it shows that it went up and just kind of stalled for a little bit. So it just kind of gives you a different way of looking at the stock price. So those are some of the common stock charts available. Does anybody have any questions at this time before I move on? All right, looks like everybody seems to say no. So when you're using a stock chart, you can kind of just see the price, but to trade it, there's a lot of different things that traders are looking for. One of the biggest things is support and resistance. And support and resistance are areas on a price chart where supply and demand meet. This means that, you know, as price goes up and it hits an area people start selling off their stocks to start making profits. As a result, traders have a lot hard. They can't break through that area because more sellers start coming in and selling off their stocks, which then reduces the price. So one way to look at this is that supply equals selling, which equals a resistance zone. Demand, which means that people are buying stocks, becomes a support zone. So if the stock's falling and it hits an area and demand increases because people start feeling that it's a valid price to buy in, they'll start buying more, which then means that there's more buyers and sellers, and then the price will go back up. Now, one of the things that you want to do one of the hardest things I found for a while there was just trying to understand how to find support and resistance. And there's several different ways that you can go about doing this. One of the ways is creating horizontal lines based on the highs and lows of the stock price. Using trend lines, you can also use moving averages, gaps, and then some other options are just like even price points or indicators. One of the more common ways that establish support and resistance are the highs and the lows of a stock price. This is established by connecting common highs or common lows with horizontal lines. The support and resistance line becomes stronger as more price points hit it and fail to break through the line. Now, just stock price in general has a long memory. So what was a support line from months or weeks, months, even years ago can also become support again or resistance again, based even though it was several months in the past. Another high and low is that all-time highs and all-time lows can represent strong resistance or support. So those are some long-term resistance and support lines. But more on the shorter term is the previous highs and lows of a stock price. So as it goes up and then falls back down, that recent high can become a resistance zone as it tries to go back up. Now, when you're drawing the lines for highs and lows, you'll never get a perfect support and resistance line. There'll be some kind of variations. So some people will tend to use that variation and create what they call support and resistance zones. So it just means that somewhere in that area, price could be slowing down or actually fail to break through. Now, I just want to take a few minutes and kind of show you what I'm talking about here. So here is the chart of the SPY. So you can see that you have a series of highs and lows, highs and lows. And if you were to draw a line right here, you could see that the price came down, bounced off of it, rose back up, came back down, fell through again, which then kind of shows this is now an area of support. Here's another area here. You can see price kind of came up, failed to, didn't really go much further, came back down, went back up, came back down. Really never completely, it broke through the line, but it just never continued on, and then finally it failed. Came back, tried again, failed, tried again, failed. So this became a really strong support zone. But now if you look over here, it eventually broke through this support zone, and now it actually becomes a resistance area. So if you look over here, you can see that the stock hit that general resistance area, it didn't go any further, and then took off again. So you can see how beneficial it is by recognizing these support and resistance zones and to adjust, so when it starts coming down to that area, you can kind of start making some expectations like, is it going to bounce or is it going to break through? Because once it breaks through, it can make a big run, just like it did here once it broke through its initial resistance. So how do you go about drawing these different highs and lows? Well, one of the ways that I was shown is that, hold on, I'm trying to get the, is to get as much data on the chart as you can. I typically start off with a monthly time frame, and then I change it to a line chart. This just allows me to see the highs and lows based on the closes. Then I mark all of the all-time highs, and then I go back and mark all the all-time lows. And then I start creating lines in between to show where there was 2 or more price points which touched that line. Then I switch to the candlestick chart and adjust appropriately, because now I'm including the highs and the more information that's available than what's in a line chart, so the line could adjust a little bit. And then I work down to the weekly chart, add a few more, and then work down to the daily to see if there's any short term. So this seems like a lot of work to do, but once you do it for a chart, you really don't have to do it anymore for the support and resistance lines unless it starts breaking through to new areas or new support and resistance areas show up. So then you would mark those lines. But once it's there, as the price starts moving forward, you'll find that it'll actually hit those support and resistance zones again and bounce a little bit, and then either break through or bounce off it again and continue on its trend. So we'll just take a minute here to show you how I like to go about this. And so like I said, I start with the monthly. Thought I already had more data. Change it to a line. And then I start to mark the all-time highs. So here's the most recent all-time high. Here's an all-time low. So now I start going through and looking for areas that would hit a support or resistance line multiple times. So here you can see that it hits it several times. It's very close here, here, here. And you can see that over here, years later, it bounced right off that same support and that same line. So it was resistance over here, but it became support over here. Here's another one that's kind of close with these two. There's one there. And all this is really just your best interpretation. The more you do this, the easier it'll become, and you'll kind of just get a feel on how to do this for yourself. So then I change it to candlesticks, and you can see that I got a little bit of some more wicks here, so I'll actually move this up a little bit to kind of touch those upper wicks. So then I'll switch it down to a weekly and look for any zones that I might have missed. So you can kind of see that right there creates a resistance zone as try to touch it here, hit it here, hit it here, and it kind of failed before it finally broke through. You can see here's another one as it showed resistance here and here, and then again over here and here, and a little bit of support or resistance here and support over here. And then down to a daily. Kind of like that line, because it's a resistance here and a support here. And then this line, you can kind of see it's resistance here, but it's been kind of showing some support here. So we go further in. Same thing. We got resistance here, but it becomes support over here, so it kind of shows as a good line. Does anybody have any questions on how I went about that? And Drew, I'll get back. I'll be discussing that near the end, and we can talk about the software at the end. Does anybody have any questions regarding on how I kind of found support and resistance based on the highs and lows? Okay, I'm going to continue on then. So another type of support and resistance line is what is known as trend lines. These connect prices in a rising or a falling trend. In a rising trend, they usually connect the low prices in a rising trend. So if we go back to my drawings over here, this is a rising trend. So what they would do is connect these lows to kind of show a trend line. So this is, obviously something I've drawn, but it does happen often in a price chart where the price will come down and come down again, and now you've got 2 points, so you can draw a line, and you'll also often find that the price will come back and retest that line before it continues on. Same thing happens in a downtrend, but this time instead of connecting the lows, you actually connect the highs. And the same thing as it come down and then it retrace a little bit, check the area, drop again, retest it. So now you've got 2 points that you can draw a line to see if future retracements have hit that line. Now if they break through, it kind of tells you that the trend's done. Now, but it could also just break through a little bit and then come back down. So it's never perfect, but it kind of gives you a general area of where support or resistance can be for a stock price and a trend. Now, you don't always have to draw the lines to the bottoms of a rising trend or the tops of a falling trend. You can draw them on the other side if you find that it keeps rising into that same area. And one example, I'm just going to go to the SPY here real quick because it's a great example, is that it's in a rising trend, but you can see here that it hit it several times. So it came down, hit it, so now you could actually draw your line there. It retraced back, came up, hit the line again, came up and hit the line, and kind of got stuck right around that support line before it finally broke through. And you can see, so what was resistance here is now support over here. And then just recently, this last week, it kind of broke through and it's kind of giving some signals like that maybe the trend is kind of starting to break down. So you can see how just drawing just those few basic lines, you can already see support and resistance and how the chart's reacting to them. Now, the more touches that you have on a line, the stronger that trend line or support line becomes. And when I say support line, I mean both the support or the resistance line. Drawing trend lines, both using the highs and the lows, can help traders see chart patterns, which is a whole nother discussion that we're not going to get into today. But I just want to point it out that by drawing these lines, you can start to see some common patterns with prices, and then you can react to them based on when it breaks out of that pattern. Another common support and resistance line is moving averages. Now this is an actual indicator, and it's an indicator I'm going to talk about a little bit more later in this presentation, but I just wanted to bring it here because it is something that's used as support and resistance. Moving averages in general show the average stock price over a specific time period. So if you're a day trader, or an end of day type trader, you're really going to be looking at a daily chart. So each point is referenced on the day's data. But if you're a day trader and you're trading 5-minute bars, your data is then going to adjust based on the 5-minute bar. This is drawn for you by most charting softwares, so you just plug in your parameters and it'll actually draw the moving average on the chart for you. It's probably one of the most commonly used indicators by most traders. You got to figure there's thousands of traders that use a variation of different moving averages. Some common short-term moving averages are the 10, 20, or 30-day period, but anything under 50 I find is very specific to the trader themselves. Um, they have their own parameters. They may like a 9 or 27. It's up to the trader. But some of the more common long term that a lot of traders use are the 50, 100, and 200. And these really do provide a stronger support line. And the longer that the period is for a moving average, the stronger the support and resistance is. And once it becomes a stronger support and resistance, it actually introduces more volatility when it's actually broken. So if we go back and look at the SPY here, we'll show some short-term moving averages first. So you could see I've got the 10, 20, and 50 simple moving average. And they're just drawn by this charting software for me. And you can see that it kind of goes up through the 10, but it breaks the 10 quite often. But once it gets above the 20, it doesn't break the 20 as often. So, the 20 becomes a little bit stronger. And then once it gets down to the 50 also becomes a stronger resistance zone. So if we back it out, you can see back in October of 2012, it was kind of right around the 50, and then it broke down, came back, and retested it, and then just completely broke down. But then it broke through again, came up, kind of broke it a little bit, but then that's when it really started to take off. And you could see that it came back down and touched the 50 several times. Sometimes it broke, but it never really got too far away before it pulled back up. So, if you take that into context with what happened on Friday, you might want to just wait a little bit before you jump in and say, oh, it's in a bear trend now because it broke the 50. You can kind of see here and here that it's broken the 50 in the past, but it's recovered fairly quickly. So, and that's where you look into the past to try to determine what's happening in the future. So now if we look at the longer term moving averages, which are the 50, 100, and 200, you can see that the 200 is rarely broken. It's touched here and here, but for the last year and several months, it hasn't even touched the 200 moving average. And the last time that it did was here. The last time it really broke through, you could see that it just shot down very quickly. So it increased the amount of volatility that the price action had once it finally broke through and broke the trend altogether. So those are the different moving averages. Another support and resistance zone is gaps. Let's go back here. A gap is an area in the chart where there are no trades during regular market hours. This means that the price closed at one point, and during extended hours, both in the evening and then the early morning, traders bought or sold that stock and made the price jump more than what it was the previous day. There are several different types of gaps. For the purposes of today, we're not really going to be going into a lot of those different gaps. That's a whole nother discussion again. But I just wanted to bring it up because it can provide support and resistance. And the way that it does it is that the wicks of the two candles that represent the difference between that created the gaps represent the support and resistance. So we'll take a look at a stock here. And So you can see here with Texas Instruments back in July of 2013, we had a significant gap. It came down, price closed right around 37.40. And then the next day, it shot up. It opened up at 38.60. So there's this area of, area on the chart that no trades took place during regular market hours. So then the price kind of traded up, and you can kind of see, if we put a line right there, that price kind of went up a little bit, came back down, tested what is now support, and jumped back up. Didn't really kind of do much. Came back down, got stuck in this general area, came down a little bit more, hit a moving average, and then shot back up and went from there. Taking a look at another one here, which is 3M back in October 2012. This is a falling gap. And you can see this area here between the two wicks represents, since it went down, this area becomes a resistance, and this also becomes a resistance. So it came down, went back up, broke the first resistance, really didn't break this resistance, so it bounced off and price began to fall again, went back up, tested again, failed, came back down, went back through, finally broke through, but look, it came back and tested what's now support. What was once resistance is now the support, and then it took off. So you can kind of see how the gaps kind of play and give an area of resistance and support if it's broken. Now, other types of support and resistance are even price points. Now, this is, when I say even price points, this is all relative to the price of the stock. So if you've got a $10 stock, an even price point might be an even dollar. So if you're going from $9 to $10, $10 can actually represent a short-term or minor resistance zone. So once it hits it, it may have trouble breaking through and kind of fall, break down and fall back down. But then once it finally breaks through, if you're actually watching like a level 2 chart or a level 2 data, you'll actually see it also just spike right up over that $10 mark. And then, like I said, it's relative to price. So if you've got a $100 stock, that even price area might be like a $10 interval or a $25 interval. It all depends on the stock and how it trades. So it's just something that you would learn as you kind of watch the stock and just kind of see its behavior over time. Another option for support and resistance are the indicators. I've listed a couple here that are common that I know of, and that's like volume at price. This is where volume is shown to the left, and it kind of just shows that within that price range how much volume is really being, how many stocks and being sold and bought in that price range. So the more volume in that price range, the more support or resistance you're going to find there, because people are thinking that's a good area to buy or sell. Pivot points and Bollinger Bands. So, and then I'm sure there's plenty of others. So as you do your own research, you may find that you like other indicators to help you determine support and resistance, and that's fine. I'm just saying that you can use the indicators as support and resistance. So before I head on into common indicators, does anybody have any questions? Okay, doesn't look like anybody's got any questions at this time. So one of the most common and underutilized, I believe, indicators is volume. Really, this just shows the number of shares bought and sold within a given time period. It is often overlooked by traders, especially new traders, because they just don't understand the relationship volume has to price. Volume itself supports or denies the price action by measuring the commitment behind the move. So if you have a big move, but the volume's really low, you want to kind of question that and go, well, why did this move so much if there was no volume behind it? The other is the opposite. If you've got a very narrow range but volume was huge, you got to kind of sit back and kind of question what was going on to have that odd anomaly. Because if you have a very large volume range, you would kind of expect a very large candle. Volume spikes themselves can indicate possible breakthrough support or resistance, or it can also signify a reversal in an established trend. And just to kind of show an example here. So we go back to the support and resistance line. I already drawn a resistance line here back in September of 2012. You kind of see it hits it, broke through a little bit, but it didn't really break through and kind of fell back down. Tried it again, and then all of a sudden it finally broke through. And when it did, it had a huge volume spike here. So that kind of tells you that it broke the trend. Everybody's recognizing that it's breaking the trend and is getting on board. And then you see the stock go from almost $10 to $12 within in a matter of a month, just a little over a month. So those volume spikes kind of show a breakthrough. And then you also can kind of see it at tops of the trend, because now you've got people jumping in thinking, oh, okay, this trend's going great, I want to get on board, and everybody's getting on. You can see the volume spike here, and then all of a sudden the stock kind of turns around. So you just got to kind of be careful on, here's another one where everybody got on, it was a big gap, and then it just broke down. So reading volume is definitely a skill, and it takes time to learn. But if you go out to the resources that I have out on the Meetup site, there's a book out there, Volume Price Analysis, that I'm reading currently, that I found has been a very beneficial book to help me understand volume and its relation to price. The next indicator that I'll be talking about is moving averages. We already kind of talked about how they are used for support and resistance, but I'm just going to talk about how they're determined and how you can kind of use them. So moving averages smooths out a stock's closing price over a given period. So if you use a 20 period simple moving average, it takes the closing price of the last 20 days and finds the average and plots it for that day. And then when you move the next day, it looks back for the average of the last 20 days. So it just kind of smooths out and takes out the noise of all the price action. It also helps you easily to see the current direction of a stock. So even while a stock price may be falling, if the moving averages are still going upward, you can kind of say, well, okay, maybe it's just retracing or pulling back, but the trend is still in force because my moving averages are still very much sloping upwards. There's two common types of moving averages. You have the simple moving averages, which takes the, like I said, the last 20 days and evenly averages them out. So day 20 has the same weight as day 1. However, an exponential moving average takes the time periods, just like a 20-day EMA. The difference is that it applies more weight to the stock prices that are closer to the current price and less weight to the ones that are further out. So this means that if there was a big move, the exponential moving average will take an account and actually flow a little bit faster based on that big jump in price. Moving averages are considered to be lagging indicators because it's looking at past data to plot now. So it's not going to really tell you what's going on right now. It's kind of telling what's kind of happened in the past. Like with all indicators, you can adjust the time period according to your trading style or what you're looking for. So if you're a long-term trader, you're going to want to use longer-term moving averages. But if you're a short-term trader, you're probably going to want to look for moving averages that move a lot quicker. And just a couple, just something, a little bit of a strategy is that some traders like to use multiple moving averages. So let's say a 9 simple moving average and a 30 moving average, and they'll actually buy when the 9 crosses the 30, and then they'll sell when it crosses back down. But that's just a very simple example of what they do. So we'll go back here and look at the moving averages. So you can see the short ones. And you can see the flow. And these are all simple moving averages. So the 10 here, we'll look at the last 10 days in stock price and then plot a point. So when it's here, it's looking back the last 10 days. Excuse me. But as you can see, as I was saying, is that while the stock price is falling, your longer moving average is still in an upslope. So your trend is still pretty strong. Even your 20 moving average is still going up. Here it goes sideways and down a little bit, but immediately starts to head back up. So even though the price is moving all over the place, your moving averages kind of show a general slope of the direction of the trend. And if you look back over here to the left, you can see it kind of goes sideways. So the stock is really not going up or down in any direction. It's just kind of moving in a sideways trend, and then it finally takes off. So now what I was saying with crossovers is if somebody used, let's say, a 10 and a 50 crossover, they would actually enter in here and they would still be in this trade because that 10 has not crossed the 50. So that's pretty much all that I have for the moving averages. The next common indicator that people like to use is the moving average convergence divergence, or the MACD. This is calculated by subtracting a longer moving average from a shorter moving average, and then having another moving average which symbolizes a single line. This is an unbounded indicator, meaning that it can go above 0 and below 0 at any number. And some of the common indicator settings for this is 12, 26, which are the two moving averages that it uses in the calculation, and the 9 EMA, which is the trigger line. A positive MACD above 0 means that the shorter moving average is above the longer moving average and is gaining momentum, meaning that it's getting further and further away from the longer moving average. When the MACD crosses the center line, it can signal that the shorter MA crossed the longer MA. So whether it's crossing down or crossing up, it means that the two moving averages crossed. Some traders use the crossover of the MACD and the signal line to enter and exit trades. They also use the crossover of the center line or 0 to enter and exit trades. The MACD often shows signs of trend reversals through divergence. And we'll go over here in SPY and take a look at that. So the indicator here down at the bottom is the MACD. And let me just get rid of these other ones here real quick. So you can see that here it crosses, this is the center line here at 0. And then if we were also to put, let's see if I could put the 12 and 26 on here. So you see here that it crossed zero on the MACD line, and you also could see that it crossed up here on the 12 and 26 moving averages. And then it crossed back over. Looks like I'm a little bit off, so maybe I got the wrong moving averages here, but you can see that it crosses over the zero and that the moving averages are crossing over too. And then it's starting to pull away, and you can see that the shorter moving average is pulling away from the longer moving average, which means that the MACD is going up. As they start to come down or come closer up here on the price chart, you can see that it starts to drop, saying that they're coming closer and that they actually start to cross. So, and then also with divergence, MACD is a popular indicator to use for divergence. And what I mean by divergence is that the indicator will be going in the opposite direction of what the price is going in. So here is an example of where price has been going up, and I drew that with that trend line. But if we go down here and draw that same area on the indicator, the highs of that indicator have actually been going down. So the fact that this is going down and price has been going up is what's called divergence. And during this time, a lot of traders were if you read the blogs and things, people were like, "Oh, we're in a big divergence." They're really expecting the trend to change and go back down. However, that did not happen. Price kept on going. So while divergence can be an indicator that the trend might be changing, you can't always rely on it to be factual. It's just another indicator or way to identify a possible change in the direction of the trend. The next indicator we're going to talk about is the stochastic oscillator. It's a momentum indicator. Shows the location of close the close relative. Sorry, I'm saying that wrong. The relative price, the current price relative to the high and low range over a set period. So the common interval is 14 with a trigger line of 3. So what this means is that it takes the current price of today, subtracts it from both the high and the low, the highest price and the lowest price within the last 14 days, divides the values and multiplies it by 100, and then plots that point. The 3 is the moving averages, so it kind of follows the line, but it's off a little bit and represents a trigger line. And that trigger line is used to enter and exit trades. This indicator is range bound, meaning that it goes from 0 to 100, unlike the MACD, which was unbound. Any readings that are over 80 are considered overbought, and any readings under 20 are considered oversold. Now, just because it's overbought and oversold does not mean that the stock price is going to be automatically changing and be going the opposite direction soon. It's just another way of saying that, hey, it's oversold. There's the possibility that it could be changing. So don't ever think that, oh, it's starting to go back up, I have to buy. If it's in an oversold area, you're going to get knocked out pretty quick. It's not always great. It's just another indicator to kind of show you what could happen. The oscillator, the stochastic, isn't really ideal for trending markets, but it's great in sideways markets. It also is used to recognize divergences as well. So if we go back to the SPY and look at that indicator, So you can see the range here from 0 to 100, and that it just oscillates up and down, up and down, up and down. And as you can see here, the reason why it's not great in trends is because here it goes up and it just kind of sits up here as the stock continues to rise. And then even though it dropped right here, it dropped a lot, but price really didn't drop that a whole lot. Now here, even though it's an uptrend, it still was kind of within a trading range. So you can see that the price came down, price went up, price went down, price went up, price went down. So when you're in a trading range, a strong trading range like this, or a sideways trading range, the stochastic oscillator really comes useful to recognize when it's kind of high and then when it's going to start to turn and move lower. And then also you can also draw trend lines on these, support and resistant lines on these if you want to say, hey, if it's anything over this, oops. Anything that goes over that line might be like, oh, that's really oversold, or anything that's hit that line in the past, it's gone down. So you can draw on the indicator to represent different support and resistance lines or divergence lines. The last indicator that we're going to talk about is the relative strength index. It's another momentum oscillator that measures the change of price movements. The common interval is 14, meaning that it looks back the last 14 days. It's a range bound, meaning that the range is from 0 to 100. With this, though, when it's considered overbought, it's when it's over 70, and it's considered oversold when it's under 30. It's considered bullish when, and the trend is considered to be bullish when it's over 50 and bearish when it's under 50. So what that means is, like the stochastics, it's not really great in a trending stock price, but you'll find that once it is in a trend and it gets above that 50 line and it's an upwards trend, it'll kind of stay above that 50 line while it's up in that trend. So it stays in a bullish area, and then once it starts to break down, you'll see it start to break down below that 50, and that might be a signal or that, hey, this trend may be starting to break down. But like most oscillators, it works best in a sideways trend, and it too can also be used to find divergences. So we'll just go back to here. And here's the RSI, and you can see the lines here representing about the 70 and the 30. So anything underneath this line here is oversold. We're oversold here and oversold here. And anything above the 70 is overbought. But you can see that, hey, it's overbought here, but price has gone up. But what you can also see is a divergence. So the highs there were going down, but the highs here were going up. So that could be an indicator that, hey, the trend could be reversing soon. I need to pay a little more attention to price and maybe tighten up my stops. Here's another divergence over here to the left, going in the opposite direction. So this is, the price is going down, but the indicator here is going up. So this is a bullish divergence, saying that, okay, well, price kept going, but the indicator was going up. Shows that there's a possible sign that the trend could be changing, and sure enough, it went up, hit a lower high, or higher low, went up, and then took off. And then kind of the opposite here, but it didn't quite go as far before it took off again. So you can see how a divergence can kind of show you areas that, you got to kind of start being a little more aware of what's going on in the price chart. So before I continue on, was there any questions that anybody had with the moving averages? And I'm just seeing your comment now, Mike. So as Mike was saying that the reason why my cross points weren't matching is because my time periods were off. So if we look back at the SPY here, take that off. So what Mike pointed out, and thank you for pointing that out, Mike, with the MACD, if you have the moving averages that are the same up on the price chart and you have the same settings on the MACD, when it crosses the zero line, you'll actually cross on the moving averages. So right here, I cross the zero downwards on the MACD, and you can see that the shorter moving average up here in the price crosses over the longer term moving averages and moves down. And then it crosses back over here, kind of pulled away a little bit. You can see it does it there and over here. All right. So that was all about, a little bit of all the different price charts, the different price charts that you had, the indicators, support and resistance, and just a little bit on how to read the charts. However, in order to read charts, you need software to build the charts for you. To do it by hand back in the old days takes a lot of time and effort, and it's doable, but the software we have today will do it in split seconds and do so much more for you without you having to really even do anything. So we'll go now and start talking about the software. Um, just like with any charting software, it's to plot the financial instruments price over time. There's different types of software available. You got your desktop applications, and this is software that you install on your desktop and run from the desktop. Then you have web applications, and these are ones that are hosted within the website. And those are nice because then you can view that stock chart anywhere that you go. You don't need as long as you got a computer somewhere and the internet, you can view the stock chart. But with a desktop, if you don't bring your computer, you lose all your settings and you'd have to install it elsewhere and redo everything. And so, but desktops tend to have a lot more features than the web applications. So just be aware of that. And you can use other software like Excel. Excel actually does do some minimal charting for you, uh, but it's just not as robust, and you got to manually do a lot of stuff like getting the data values in there and everything like that. So, which one's the best? Well, there isn't. I still flip flop between different charting softwares because I like it for one feature or I like this for that, and still haven't nailed down which one's my favorite. But I just wanted to provide you a lot of different features that you may want to consider when you're looking for a stock software charting software for yourself. Um, Obviously the biggest one is the financial instruments. If you're a futures or forex trader, not all stock chart software is going to provide that ability to plot that information for you. Cost, some are free, some cost hundreds of dollars. Um, it all depends on the features that you want and what you need for your trading style. The data series. This means the data that's coming in and being plotted to your chart. You can get what they call end of day data, which means that you just get an update nightly of all of the days high, low,
opening and close prices. But if you're a day trader, you need live data. So you need data that comes in regularly and streams it, so it's a constant stream of information and you can see every change on the stock chart. Some software allows you to provide your own provider for the data stream. Others provide it for you and you just pay a higher fee in order to get a live feed or an end of day feed. So it all just depends on your trading style and what you need for the data. Um, Time frame, uh, again, it's if you need uh, if you're a day trader and you need minute data, or you're just an end of day trader and you just need daily or monthly, that will also determine the type of charting software you have. Because you're not, if you're an end of day trader, there's no need for you to need a very sophisticated chart system that is going to show every buy and sell of the stock, because that information is just information overload for you. Analysis type. Um, some people like to use custom indicators and have built formulas to build those indicators. So if you're one of those types or you want to become one of those types, you're going to need a software that allows you that programming option where you could put in your own indicators. Others just provide you with the common set of indicators and that's all you get to use. But for most traders, that's enough. So it all depends on what you need. Another really big thing is the drawing tools. Can you draw the support and resistance lines? Can you draw trend lines? A lot of people like to draw Fibonacci's. Some people like to use Elliott waves. So you want to find charting software that allows you to have the drawing tools that you want to use. Um, some software allows you to actually connect to your broker without using the broker's, excuse me, the broker's software. So if you have a broker, they typically have their own charting software, but um, sometimes it's not as robust as some of the desktop versions that you can get. So those desktops will allow you to actually connect to your broker and still make trades through your broker, but you get to use a more robust solution. And there's several others here, but those are some of the things you need to think about when you're looking for charting software. Excuse me, one second, please. All right. So once you've kind of figured out what you need, um, you can go out and get your charting software. And there's many options. But here's just a couple recommendations I have for the beginners. Um, if you've got a stockbroker, they usually have charting software for you already. Um, Sometimes it's free, sometimes you do have to pay some money, but I found that a lot of them are free if you're an active trader. Um, like E-Trade, it's $100, but if you make so many trades within a 3 month period, they give it to you for free, and it has a lot of options there for what you need, and you also get live data streams if you get that software. Um, Myself, I started with stockcharts.com. Um, they have the free version, and but the reason why I like those guys was that they had a lot. They have what they call the stock charts school, and they do a really good job of explaining all of the different technical analysis theories and indicators and examples. Um, they're very focused on providing charting solutions for the based around technical analysis. And like I said, the free version's available, and you can add some basic stuff. Um, but their subscription fee is like, I think it was $25 is the one that I use, and then that allows you to build scans, so you can create a scanner that then will scan each night for you and find stocks that meet that scan. Then you can start to customize it a little bit. You can't really do much by adding new indicators or anything like that, but for a beginner, what they have is a lot of information to get you started and to get you going. Um, Another software that is really a big full feature software is Thinkorswim. And this is actually provided free by TD Ameritrade. Um, and I use this one a lot too now, as I've grown as a trader, and I like it because it's free. It doesn't provide free live data for the free version, but I'm more of an end of day trader, so it updates all the data to me at night, and I could see what's happened throughout the day. And then it also's got virtual trading. So if I feel like I want to practice a new theory, I've actually got $100,000 practice account that I can play with, and just learn and trade the different ways. So, and like I said, it's a very robust solution. It allows you to view a lot of different financial instruments. It allows you to customize your own indicators. Um, the only problem is it's a little advanced for beginners, but if you've been trading for a little while, it's a great free solution. Um, and just so you know, there's a resource document out on the Securities Trader Group meetup page. If you go to more and files, I've put a document out there with links to blogs and educational information, but there's also a section there on some different software and some of the costs that go around those. Um, so it's just, I can't say that there's a perfect one, because it all depends on, your personality and what you like. But hopefully with that resource document, you can get an idea of some of the things you're looking for, and some ideas of the different types out there. So that's pretty much all that I have for today. I do want to talk about the next meetup real quick. Uh, Start on February 23rd. We're going to be having another meetup. It's called Approach Trading Like a Business. For that meeting, I'm going to be talking about how to organize your trading life and how to approach trading similar in such a way that it's similar like you would approach a business, and in the sense of the documentation, setting goals, having measurable objectives, so that then you can go back and look at it and adjust accordingly, and really just try to build all this information around your trading life to help take away the emotional aspect. So when you start falling out of your plans and your goals and objectives, you can go back to this trading plan and revise it and relearn it, and kind of pull yourself back into what you defined yourself as a trader. So it's really kind of a way to help you uh, look at yourself as a trader, and to go forward with a specific set of rules and objectives, so that you're not being emotional about your trading. Like I said, it's going to be February 23rd. This will actually be a live meeting, and we're going to be hosting it at the Southeast Regional Library, which is off of between Southside Boulevard and Gate Parkway. It's going to be a Sunday, and it'll be running from 1 to 3. And, we've got up to about 50 people in there, so, we'll have more than enough people for the whole group. So, with that in mind, are there any questions? I did take everybody off of mute, so I can hear you if you want to talk and ask some questions.
Thanks for putting this together, Craig.
Oh, no problem.
Craig, I like your two picks for your software choices, especially because they're both very app friendly and mobile friendly.
The Thinkorswim. I didn't think that was mobile friendly. Oh, mobile. Yeah, the that's right. That does have a mobile app.
The app is killer, and StockCharts.com is really iPhone friendly, and most aren't.
Yeah, yeah. I haven't used it on the iPhone. I've got an Android, but I also do show it on my Kindle at times. Because even though it doesn't have a live feed, it does have 15-second to a minute update. So it'll just like update every minute or so. And I'll just sometimes put that at my desk and just let it run, and I'll just glance over. And if I'm like looking for it to hit a certain price, so that's if I'm really just watching a stock.
Yeah.
But yeah, I started off with stockcharts.com, and that was really what got me going into trading, and just with the amount of information they have out there is worth it alone. So there's no questions, nothing, anything you guys want me to look at? Wow. Okay. All right, guys. Well, it doesn't appear that there's any questions, so I'm going to call an end to this meeting. And I just want to thank you all for coming out today. I also will be sending out a survey just to kind of get an idea of how the presentation went, what I can do better, and how I can improve for future meetings. So it's all anonymous, so just please take a few minutes and get that filled out when you get a chance.
Greg, what was that software you were using during the demo?
Oh, this is actually a new one that I've kind of started to learn, and it's Trade Navigator.
Cool.
And actually, the reason why I like this software is, and it's something that I'm going to be talking about in a future presentation, is it's got market replay. If I can remember how to do this. Just give me a second. I haven't used it recently.
Yeah, it also allows for a lot of custom, custom indicators or modifications. I've used this product before. It's pretty cool.
Yeah, yeah. I can't find it. What I'm looking for right now.
I forget. I haven't used that option too much. The replay history there down on that one. I think it's that one, isn't it?
Yeah, it says that I'm not. It's more real time there, but it should play.
Is it? It
Oh, there it is.
usually it
Replay
opens
history.
up. Yeah.
All right. So this is what I kind of liked is that I have like a set of stocks that I put together as like my watch list. So I can pick that, and then I thought there was a randomizer. So you can go game mode, and then you just click start replay. It didn't work.
Maybe you don't have the data that far back.
Yeah, just give me a second. I probably have to update the data. Okay, so what it did is it went back to this time period of February 12th, and then I can hit play. So this is like a practice tool. So I can go in and you know mark my support and resistance zones. Um, Anything that I think is a support and resistance zone. And then I can hit play. And just keep going forward here. And it's like, oh, well, that just jumped up, but now it's at a resistance zone. Now it just broke through. So now that's kind of saying, oh, I'm ready. So maybe like the next candle, if it goes above that, I'll buy.
Oh
And then it
boy.
didn't. So then it did. It failed the support zone. So there, it's above it. Oh, there it broke down again. It's above it. So that's like the first candle that's above it. So I would maybe buy at that point, and then you could just mark it down on a piece of paper. Oh,
That's cool.
you know, and it's like, oh well, okay, you know. But what was then I would set my stop. Let's say if I set my stop there, so then I would say, okay, well, let's mark it with this. Let's say I got in, and here's my stop, because that's like the next resistance zone. So I never really hit my stop. So, okay, well, I'm still in the trade. You know, I might be a little worried because it's not doing anything. Oh, there it hit my stop. So now I'm out. I would have been out on this candle because it hit my stop.
Yep.
So I just mark it down and, you know, go, well, that wasn't real great. And then I can go back and go, well, you know, that MACD was pretty high. Or, you know, I can look at, you know, the fast moving averages and, you know, be like, oh, you know, it did break above it, but now it's back below it, you know. So it's just a way to really kind of analyze and to practice trading without really losing any money. And then it's like, okay, well, I did that previous line, and you can see that it hit that line and it bounced up.
Yep.
So it really shows that, okay, well, past, you know, that the stock price has got a good memory, because here was a resistance zone over here, and now it was a support zone there, and it's a support zone here again. So it just kind of confirms that. Oh, and then it just broke down again. So now I'm really kind of seeing that I'm in a bear trade, so I'm not really looking for any bullish trades. I would really be considering bearish trades. So that's just one thing I really liked about this piece of software, is it allows you to really just practice trading without, you know, almost instantaneously. So you can actually speed it up. So I'll just hit play and it'll just run through it now. And then if there's something, be like, oh, well, I really hope, you know, it's like, oh, I wanted to maybe buy a trade there because that's a resistance zone here or support zone. It broke through. I could be like, oh, I want to do a bearish play now. And then I just hit, so I mark my paper saying, oh, I'm in the trade. Here's my stop here. See what it's doing. Almost hit it, and then boom, it kept going. So now I want to move my stop down there. You know, just whatever I want to think I need to do. And I would have gotten stopped out. So it's just, like I said, it's just a way to kind of play and practice different ideas and thoughts. Then you can just change it as you go. And as you can see, that these lines that I drew in the past are really holding up as the stock price hits in the future. It just really gives you a confirmation and, you know, confidence in what you're doing is right. And then it's just a matter of learning, you know, how to recognize when you should or should not be getting into a trade.
And you could probably do that replay intraday as well, right?
Only if you have this streaming data, like the interday data, which is
Right.
like $90 a month.
Oh.
This here for just the end of day data is $30 a month.
Cool.
So, you know, and just kind of point out something too. It's like I talked about volume spikes and breakouts. So you could see here that this was a strong area of resistance. It broke out here, and look at that volume spike right down here, which would have been a good indication like, hey, this is starting, you know, starting to take off. The moving averages are moving forward or moving upwards. So once it broke this area here, you could have gotten in and, you know, made $17 on your trade easily. $20 at this point. So it's just a good way to practice and, you know, work out your ideas and solidify your trading practice.
I mean, if you want, I don't want to,
Any other questions?
I don't want to ask about a specific style.
Gary, did I answer your question?
I'm not sure if he has the ability to respond. There's no mic next to his name.
Yeah, he should be able in the chat. Now, were you guys able to see everybody else's chat?
As long as it's published to everyone.
Right, okay, okay. Well, that'll be good in case there's people that want to moderate, you know, they can watch the comments and, you know, answer while somebody's giving a presentation. Because I know I can jump over and get distracted really easily, so I try not to watch the chats as it's going on. Any other questions, comments, anything you want to discuss?
I'm impressed, bro. Thanks again.
Thank you, thank you. All right, guys, well, I'm going to close up the conference here, and I believe that I can get a recording out of this, so if I do, I'll probably be putting it up on YouTube, and I'll get that published out to everybody, so if you want to get a copy of it yourselves, you can. And again, I will be putting out a survey, and just take a few minutes and fill out the survey for me. I'd really appreciate it.
Will do.
All right, have a great weekend, guys.